All right, so let's start this video off with a story. So a couple of years ago when I was working at the bank, it was my first year or two working at the bank, I met a customer who came in. He looked like he had been seriously hurt, and that's important because he had recently just finished recovering from the hospital after he pretty much fell while on the job. Based off the story, it sounded like he was significantly hurt, and I was just personally glad he was okay. But he was better than okay. He actually won a settlement after suing his company for malpractice that he believed resulted in his injury. The company agreed, and he then deposited his settlement check to me, which was a little bit upwards of $500,000. Mind you guys, I'm like 21 years old at the time. I'd never seen a $500,000 check or any check that size, let alone imagine what it looks like in cash or anything. So I'm thinking in my head, oh man, I would blow this up. I'd buy these cars, I'd buy these houses. I didn't really know the aspect of money even though I worked at a bank, I was really young. At the end of the transaction, I asked him the question that I'm sure a lot of people would want to ask him, and that was, what are you gonna do with the money? Keep in mind guys, we built like a 30-minute rapport. We had a long conversation. The branch was pretty dead. He was a really cool guy. He could have easily said, none of your business. I'd be like, okay, you're right. But he told me some things that me now would think pretty logical. He said he was going to pay off bills. He's going to invest a little bit. He was gonna travel, help his family out. Pretty logical, I would think so. And that was it, he left. About a month later, he came back and he was talking to one of the bankers in the lobby. All I could hear were things such as Vegas and Bentley. And then I'm like, man, he did what I would do. And now I'm thinking that's kind of disappointing. So he came up to me, talked it up again, caught up, saw how everything was doing, and he seemed really fine. And I pulled up his account to do a transaction he wanted me to do, and all of his money was gone. He bought a car. He bought, I think, his wife a car. He went to Vegas. He pretty much blew it up in a month. How do you get rid of that much money in a short period of time? Better yet, what would you do with it instead? What's up guys, my name is Darren Jackson, welcome back to the channel. And if you paid attention to that recent story closely enough, you came to the conclusion, as I did, that $500,000, as big as it is, can be washed away as quickly as nothing. Being the investor that I am now with the mindset of money that I have now, there's a lot I personally would have done a lot differently than what this customer did. Granted, it was his money. He did whatever he wanted to do with it. He did things that made him happy. I personally don't believe that money buys you happiness, but it definitely helps. So in a sense, you don't blame him. But there's a lot of things that you could have done because that's a significant amount of money. So in this video, we're gonna talk about some things that I advise that you guys should do if you were to inherit a lump sum of money, or more so things that I would do that maybe you agree upon and we can kind of learn something together. But as you watch this video, guys, make sure you leave comments below. Let me know what you would do, what you think of my personal opinions, and let's get started. So let's go off the mindset of it being $500,000. Personally, the first thing you should do, and this is also / disclaimer, is to hire a CPA or a financial advisor, which I am not. And the reason you want to do that is because based off how you receive the money, if you received it from the lottery or it was like a huge bonus from work or something like that, if it's considered taxable income, then your tax bracket is going to be way higher than it once was, and you're gonna have to owe a lot of taxes on that. So you may be able to speak with someone licensed that may be able to help you soften the blows of the taxes you're gonna have to pay the following year. That's the first thing I would do. It's more so the default thing before the first thing. The first thing will definitely help with this, and that's look into putting a lot of money into a high yield savings account. For $500,000, maybe you can put, I don't know, a quarter of it into it at least. You definitely want to put it into a high yield savings account because especially if you're having to pay taxes on that money, you'll hopefully build a little bit more money over time just by keeping it into a high yield savings account that you can use to pay it off. There are multiple banks such as Ally Bank that offer a high interest rate in comparison to other banks and even some credit unions on a normal year. I say normal year because this year interest rates have dropped to help people be able to afford things and apply for mortgages and stuff like that, basically to help re-stimulate the economy since we're going through this pandemic. But in a regular year, you want to keep an eye on those high yield savings accounts and put a lot of money into it. It's also really beneficial because the mindset is to at least have 3 to 6 months worth of living expenses, aka how much money am I paying in bills, gas, groceries every single month, and try to have at least 3 to 6 months or even a year of it into an account that you never touch unless it's an emergency. So that's the first thing that I would do and suggest you guys to do. Now, once you're done with that, and in my opinion, this is regardless if you have a job that offers you a 401k, I would advise you to open an IRA, whether it's a traditional or a Roth. Remember guys, an IRA stands for an individual retirement account. It's basically an account that you would set up for yourself if you didn't have an employer, if you were self-employed, or if you just want to have a little bit extra savings for when you retire. And there's two different types of IRAs. You have the traditional IRA, which is the most similar to a 401k, in which that when you deposit funds, you're not taxed at that point. But when you reach the age of 59 and a half and you withdraw all the money, you're taxed at that tax bracket at that age. On the other hand, you have the Roth IRA, and the Roth IRA taxes you upon every deposit, but then the money grows tax-free over time and you're able to withdraw it tax-free at retirement age. Personally, I think the Roth IRA is more beneficial and will save you more money in the long run because especially if you're working to make more money over time, more than likely you'll make more money on an annual basis once you're older in comparison to once you're younger. Therefore, it'll put you in a higher tax bracket. Now, if you don't expect to make more money when you're older, then it's kind of up for grabs on which one you should select. But regardless, they each have a max of a $6,000 deposit that you can make every single year, unless you're, I believe, at the age of 50, in which that ups to $7,000. So that's the second thing I would do. Oh, and on a side note, another thing that's beneficial about IRAs is that you can create a portfolio on your own to put the funds into. One ETF that I would recommend using as a portfolio by default is VTI, which is a Vanguard Total Stock Market ETF. It's basically an ETF that covers the entire stock market. So that's a lot of volatility you're avoiding on a regular year, and it does pay dividends as well, so that's something that's really beneficial. Speaking of investing, the third thing I would do is invest in stocks, bonds, ETFs, and anything like that. For one, it's really beneficial because you can make a lot of capital growth. The stock market typically increases between 6 to maybe 8% on a yearly basis, so that's a lot of returns you can get on capital gains that you could use in the immediate future or upon retirement. You could also make money on passive incomes with dividends if you invest in dividend stocks, things such as Coca-Cola and Apple. So those are really beneficial as well. You can invest into ETFs, such as my favorite, which is SPHD, which tracks the top dividend paying and lowest volatility within the S&P 500. Or you can invest in some REIT stocks, which is basically investing in a real estate without being a real estate agent. And those are stocks that can range from Realty Income, which is one of my favorites and pays a monthly dividend, and Stag Industrial, which is also another great rate, which also pays a monthly dividend income. The fourth thing I would do is donate to a charity. Of course, it's amazing to be able to have a lot of money for yourself, but it's great to be able to give it to those in need, especially during the holiday times. It's really important. Of course, yes, donating to a charity you can use as a tax write-off. It's definitely beneficial on that end, but it's more beneficial to help those where a fraction of your inheritance would make their entire day, their year, or their life. So that's definitely something you should consider doing as well. The fifth and final thing I would recommend you guys do if you had a lump sum of money that you just inherited is invest in yourself. That almost has nothing to do with money, except for the first suggestion, which is travel, which is gonna cost some money. But definitely spend time traveling, go to places you've never been to before, maybe learn something, pick up a language. You could also start a small business if you made that much money, create some more passive income, and maybe that's also something that will help the community out. That's definitely, possibly the most important thing you could do, because you definitely have to spend your time the way you want to. And yes, money is an amazing asset, but I believe nothing beats the asset of time, because we only have so much of it and you want to use it the way that you would love to use it. So definitely consider that. Hopefully all of these are great advices. Again, I'm no financial advisor. This is kind of my personal opinion on what I would do. And hopefully this is something you agree with, or at least a little bit. But again, definitely leave your comments below. Let me know if you feel like this advice would at least have $500,000 last more than a month, or how exactly would you do it? Let me know in the comments below. Make sure you guys check out some of these other videos, which I hope help you on your investing journey as they have in mine. I do appreciate you guys taking the time to watch me talk about random nonsense today. And until next time, take care.